A doom loop threatens to start? A currency war. I'm your host, Steve Van Metre, and thanks for joining me today. And as the dollar heads higher, it's starting to make headline news as it threatens to trigger a doom loop and start a currency war. But how bad can this get, you ask? Well, it could get pretty bad. Let's go to Bloomberg, where we kick today's stories off, as this could be the start of a dollar doom loop like no other, as a reverse currency war beckons. The dollar's gain is the world's pain, and based on its current trajectory, the world may be in for a whole lot more discomfort. Concerns over global growth have recently sent the Bloomberg Dollar Index to the strongest level on record, with the greenback hitting multi-decade highs against currencies like the euro and the yen. But the move risks becoming a self-reinforcing feedback loop, given that the vast majority of cross-border trade is still denominated in dollars, and a stronger U.S. currency has historically translated into a broad hit to the world economy. And that is a big key to understanding today's story, is a stronger dollar does have an impact on global trade. We're going to get into that a little more, but let's continue on with the story, because this is a big deal, and it's going to get worse. Against the backdrop of higher than expected inflation and still elevated commodity prices, the concern is that we're in for a dollar doom loop like never before, according to John Turek, the founder of JST Advisors. With the Federal Reserve hiking interest rates at the fastest pace in decades, he says, it's much less clear what could break the feedback loop in the next few months. And this is the first myth that we have to overcome, is because the prevailing view is that central banks have all this omnipotent power over currencies, and they can just wave their magic wands, move monetary policy around, and they control currencies. And of course, the excuse here is we're seeing, and the prevailing view is, well, if the Fed is tightening, well, it must mean that the dollar is going to go up in value. But is that always true? Well, not really. Let's take a look at some charts here, just so you can understand that this it makes sense, but not entirely, because here you can see the federal funds rate in blue, and I'll show you the trade weighted dollar first. Now, this series on the Fed database was discontinued, so we'll look at the nominal dollar here in a moment. But notice that the logic sort of makes sense. Hey, the Fed's raising rates, the dollar's going to get stronger. But here's a whole cycle that started in around late 2004 into 2005. And notably, the Fed was raising rates, and you can see the dollar weakened. So that doesn't make any sense at all. In fact, here we see the Fed cutting rates, the dollar going up. And then, of course, the argument is, well, the dollar was leading, of course, the next tightening cycle that started in late 2015. But how about we look at the nominal broad dollar index, which I thought I had a chart of, but I do. It's coming soon. Let's continue on with the story, because I just wanted you to understand that this whole idea that the Fed is in control of the dollar doesn't make any sense, but that's what people think. Now, what makes this version of the doom loop really scary is it's kind of hard to see how those circuit breakers play out over the near term. Turk says in a recent podcast that we have a European problem, which creates pressure on the euro, which sends the dollar higher, which worsens the manufacturing cycle, which does this whole thing again. But is the Fed going to pivot with spot inflation at an 8 handle? Well, now it's at a 9 handle, and that's not going to be enough to get the Fed to pivot. In fact, in a week from now, today, we're going to get the FOMC decision, likely to see an increase in rates, which many believe now that will lead to a stronger dollar. But of course, how does all this trade come together? Why is a strong dollar such a problem for global trade? Well, let's first look at a couple charts, and then we'll explain that. And here you can see the trade-weighted dollar, the same chart as before, against the consumer price index on a year-over-year rate of change. And notably, what do we see what happens to consumer prices as the dollar goes up? Well, you see the dollar rising. And what does that mean, of course, for the consumer price index? It puts downward pressure on it. You can see it did rally up here, but then it came back down. And then you see as the dollar goes down, then of course consumer prices are rising. We see the dollar shoot up, consumer prices come crashing down, the dollar weakens, consumer prices rise, and then you see the dollar going this kind of long trendy rally here. And what do you notice? Consumer prices are fall, they rebound a little bit, but then they continue their overall downward trajectory. Here's the nominal broad dollar chart that I thought was earlier, but here we see again against the consumer price index, what we note is that, again, as the dollar gets stronger, it puts downward pressure on consumer prices. So here we see consumer prices rising, the dollar rising, and of course that's threatening to bring inflation down rapidly. And that's what Turek is trying to suggest here, is that, wait a minute, the Feds continue to tighten here, they're going to drive the dollar higher, and all of a sudden inflation is going to come crashing down like it did during the great financial crisis. And what will be the pivot? Will they be able to slow down? Because maybe they've gone too far. Well, that's what the Fed always does, and that's part of the problem here. But let's continue on, because of course, there have been periods of notable dollar strength before, such as in 2016 or 2018, but back then the currency gained as the Fed sought to tighten policy and then stop once the central bank stayed its hand. And with the data released last week showing the US CPI surging 9.1% year on year in June, the Fed has much less wiggle room to reverse course. Because again, this is all about the Fed, and everyone's got it wrong. Has nothing really to do with the Fed, as we'll see later in today's show. So the key question is, to what extent the strong dollar reduces the Fed inclination to go bigger on interest rates hike in the coming months, in turn potentially providing some relief to exporters and leverage borrowers around the world. So let's first address the first piece. The Fed will comment about the dollar, maybe, and it will have no impact. All the Fed cares is about that headline number, how it impacts you and consumers. This has become a political issue. Get inflation down at any cost. It doesn't matter if this because the dollar's going higher or you cut demand. It doesn't matter. Get inflation down. Now, why does this have to do with global trade in terms of bringing relief to exporters and leverage borrowers? Well, let's first talk about leverage borrowers, because in the global economy, as the global reserve currency, people borrow in dollars to conduct global trade. So when the dollar is going up in value, what does it mean? Well, it means the same thing as anything going up in value. It means there's a demand for it. It means it's potentially scarce. There's not a lot of them out there based on the demand for them. And so that means if you are leveraged borrower, meaning you borrow money in dollars and you made some leverage bets, well, if you're having trouble getting dollars to repay those loans, it means you can enter delinquency and default. We see that happen. In fact, we've seen it happen during the great financial crisis. Now, for exporters, this is really bad news, because for the U.S. economy, a stronger dollar, while most Americans may think that's a sign of confidence, for the U.S. economy, it's actually really bad news. And I'll show you here on some charts. When we look at the trade balance in goods and services in blue, this is a trade deficit. So when you see this going down, the blue line falling, it means the trade deficit is widening. And notably, we came off record low trade deficits here recently. And I've got the nominal broad US dollar index overlaid in red. And so the idea of what you're seeing here is, as the dollar weakens, you'll notice it tends to be that's good for global trade. You see the dollar going down here, and the trade deficit, not as bad. It starts to ease up a bit. So it narrows, and then you'll see the dollar shooting higher. Of course, this was during a recession, so demand fell. But notably, what happens then, the dollar weakened following recession, and then broadly speaking, you'll notice the dollar started to head higher. And what does that mean for global trade? Well, it means the trade deficit gets bigger. And this is bad for exporters in the U.S., because a lot of people don't see that the U.S. is competing with foreign labor and foreign producers. And we're doing this every day. And the currency is a variable that U.S. domestic producers, they can't control. They have no control over it. So when the dollar is weak, they're more competitive against their foreign counterparts. When the dollar is strong, and we've talked about this on the show, if you're a foreign producer, you can undercut domestic producers all day long. And that's why you see the surge in this trade deficit, because they're looking at their product, their widget, and saying, look, if we can export it over there, we can make a lot more money, because those people will pay a fortune for it, and we can undercut their domestic producers by a little bit and gain market share. And that's why you see this in that comment then of, hey, perhaps if the dollar weakened, it'd be good for U.S. exports. Well, it would be. And that's why we see, when we look in the next chart, that profits go down when the dollar gets stronger. In fact, didn't do this in these charts, but I could actually invert the dollar here. And you'll notice there's nearly a mirror relationship between the two, that as the dollar weakens, corporate profits shown in blue goes up. And as the dollar starts to go up in value, what happens? Corporate profit growth slows down and starts to go down. And then you'll notice it continued to see corporate profits going nowhere since about 2012 all the way through 2020. As the dollar gains strength, the dollar weakens, corporate profits shot higher, and now the dollar's headed higher. And the prevailing view, and you look at this in the markets over the last 2 days, as people flood in and buying stocks again because they think perhaps this earnings season is the worst. This is it. This is going to get better from here. And the dollar's telling them not going to happen. In fact, if you're concerned at all what worsening corporate profits could mean to your portfolio and stock prices going forward, well, you shouldn't be. I'll put a link up here to Portfolio Shield and the description below, because by the end of today's show, you're going to have a deeper understanding of why it works the way it does, why its hedging is so special. Now let's continue on with the story, because we've got more about the dollar, as it's a little hard to see what stops this, and that's the concern. What happens now when the dollar goes up and it won't come down, or perhaps that we have to keep tightening as the prevailing view that the Fed is in control here to bring inflation down? What's going to stop the dollar from going up? Good question. And I guess the best answer to that is it could just stop itself, says Turek. Something to start to think about, especially past the September FOMC and really into the end of the year, depending on how bad the growth conditions are, especially in Europe, is will the Fed sort of be able to do this implicit handoff from interest rates to global economic conditions? Great question, because again, here is a Bloomberg chart that they cite that, hey, look, the dollar goes up and it leads the federal funds rate. Of course, they don't really show here the dollar went down as they don't really point out the dollar went down, the federal funds rate continued to rise. And here you see them saying, look, the dollar is leading the funds rate higher, but we already debunked the fact that those two aren't really correlated. There is no transmission mechanism there. But what is all of this? Well, we'll get to that in a moment, as when it comes to the dollar loop, there are many transmission channels, as researchers such as the International Monetary Fund have shown that the dollar's role in global trade means that a stronger U.S. currency can lead to a tightening of global financial conditions and a hit to real investment, as I just showed you in terms of U.S. corporate profits and demand. So when that falls in the U.S., of course, the rest of the world gets hit too. People want a moderately strong dollar, not too strong, not too weak, but kind of right in the middle, just like Goldilocks in his porridge. Let's go on, because the U.S. currency also has a special position in world markets. When investors are worried, they tend to rush to the safety of the dollar-denominated assets, setting the currency even higher. That's one reason the dollar surged when the markets crashed in March of 2020, and that's why it's been strengthening now. Actually, the reason it happened in 2020 wasn't because it was a flight to safety per se. It was because there was such a dollar shortage that people needed dollars and they were willing to pay any price to get them. We're in a world now where central banks who are dealing with above target inflation have little tolerance for massive currency weakness, because it's thought only to amplify the pressure they're dealing with by hiking rates. We are in this sort of reverse currency war, he suggests, where central banks are clearly making an emphasis on the role of currencies, some more explicit than others. Given the nature of the shock, it does make sense for central banks to have a very big, overarching currency focus, because there is some truth to that. And if the central banks could tighten currency easily and make the value go up, they could squash inflation really quickly. But here's the doom loop as it's presented, and this makes a lot of sense. The dollar gets stronger in value and it leads to lower global manufacturing, because demand in the U.S. starts to fall, domestic producers start to lose market share, and it becomes a problem, leading to slower global growth. This leads to lower commodity prices, which we'll look at shortly, lower global trade. Of course, really, actually, it leads to a temporary increase in global trade until U.S. consumers cannot afford anymore because their wages aren't keeping up. And then that leads to worries about global growth. And then, of course, back to a stronger dollar. And in the U.S., the dollar doom loop could end up doing some of the Fed's work for it when it comes to fighting inflation, as I've already pointed out, and it will. What makes this version of the doom loop so challenging is that it's a condition or an externality that the Fed, in its efforts to lower inflation and lower inflation quickly, is actually accentuating what I think is almost, in their view, positive. The question that the market participants should begin to ask is, if the dollar's doing all this work, does the Fed have to go to 4.5 or something like that? I think this is an interesting question on its own, but in terms of what arrests the current dynamic, it's really tricky. As he suggests, he's not sure what would actually cause the dollar to stop going higher, and that could be a concern because it could lead to outright deflation if the dollar continues to rise. But the question is, what is really causing all this? And for that, we turn to our chief strategist, Jeff Snyder, who we covered this in a report earlier this week or last week, but now it starts to make even more sense in his deep dive about the banking system of foreign held treasuries. And he points out, you'll notice he says he's euro dollar 1, 2, 3, 4, and now 5, where he says euro dollar, he means dollar shortage. And you can see as foreign held treasury securities come down and each of these dollar shortages, as he points out, it actually is a sign of a dollar shortage. And what it means, if that doesn't make any sense to you, all Jeff is trying to point out is, hey, the global economy is slowing down. And a lot of people don't understand why, but if we look in certain things, if we kind of uncover where the actual information is, we can see evidence of a dollar shortage, and that is in foreign held treasuries. As the economy grows, then foreigners want to hold more treasuries. And as the economy shrinks and they need dollars, what do? They sell them. It's contrary to what most people think, but that's how it works. Now, if we take Jeff's chart and we start to make some assumptions from it, what we can do is take those peaks, these where he's pointing out here, and we can look at periods of the dollar. And now we notice that periods where the dollar is relatively low and the shortage begins, you'll note the dollar goes higher. The dollar goes higher, higher, and higher. So it starts to make a lot of sense that we are in a dollar shortage. But what does that mean for rates? Well, it means they're headed down. We take those same data points, and notably, what do we see? That eventually rates fall. Rates eventually fall, go up, and then fall. And notably, even make new all-time lows, fall. Now they've gone up here, which suggests that maybe things are different, but not really, because what we're seeing is rates reacting to inflation. When we circle the same data points, we see inflation tends to go up a little more and then come crashing down, a little more down, a little more down, a little more, and then down. And then, of course, it's going up a lot, and then it will come crashing down because we come back to that whole thing about commodities, which is a great leading indicator of a dollar shortage and slowing global growth. And here we have crude oil prices on a year-over-year rate of change telling us that this is indeed a dollar shortage. The global economy is slowing, and we are facing a doom loop where the dollar could only go higher. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.